Financials, like the rest of the market, making a big comeback and ending the day slightly higher, but the sector is still on track for its worst month since February 2009, and the chart master says there's even more pain ahead. Carter, what are you looking at?
Well, let's look at a bunch of things, but here's all data. Now, again, GICS data only goes back to 1989 in the current sector nomenclature that we have. But what optically is very clear, there's your financial crisis low in 09. This is the XLF, or the actual S&P sector, and here is the high. But the interesting thing is, look where it stopped. It is literally a perfect, that's the 2007, just before the entire collapse of the U.S. banking system, and all got bailed out. And what we have, by all accounts, is a perfect double top. So let's zero in on the recent sell-off. We know financials are down hard. Now, what I'm thinking, and Grasso was referring to this to the market overall, I'm thinking at a minimum that we undo the entire election move. So that line would imply, if we were to get to it, another, let's say, 9 to 10%, just to get down to the line. Now, let's look at the next chart and draw the actual trend line. So this has worked from the financial crisis low, the U.S. debt downgrade in 2011, 2015, 16. And here we are again. Were we to get down to that, which again is this top, let's put it all together on the next chart. Here they are. I think that's what's coming. I think we're going to both find support there and the trend line. And that's the point at which one might want to get involved in financials in a big way, or even as an overweight. But then there's this, and this is the sort of thing that's inescapable. Here's our double top again, right, where we peaked in 2007. But look at the relative performance. Yes, financials off the financial crisis low, huge advance. But what did they do? Really, they did this. It's a place where money goes to die. And that's because of all the dilution, right? The issuing of shares to try to get themselves out of the big rut they were in, bankruptcy. And basically, one has not been paid, even as they've advanced, relative to what one could have done with other choices in the market. I don't think financials, basically, other than a trade, are worth being overweight.
BK here, though, disagrees.
I do. Yeah.
You say it's what, time to buy?
I think it's, yeah. I mean, look at what happened. So when I'm looking at the markets, I'm always looking for bad news, good price action. And so let's look what happened over the last week. We had Mnuchin make that ridiculous call to every single bank asking, are you liquid? The chances that we have a problem in the U.S. banking sector are so slim. The fire trucks have been pointed right at these banks since 2009. There's no chance there's going to be another fire, in my view, here. Secondly, now the sell-off has taken us to below book value, which is something that's relatively unusual. And even if you think that banks and utilities trade at book value, they're trading well below book value. And unless you think there is a recession coming in the next 3 months, that book value should actually be all right. And then the last thing is the yield curve. We talked about it flattening almost this entire year. What has it done over the last couple days? It started to tick higher. And when you start to see the yield curve re-steepen, that could be a catalyst for the banks. So for me, it's a good risk reward here.
So BK, so when I look at the chart that Carter showed up there, I've made this point about that double top. Now the run up during the financial crisis was because of the leverage that banks were allowed to take. They're not allowed to take that anymore. Mm-hmm. So they're not going to have that growth element anymore.
So the best days are behind them.
Best days are behind them. The run up out of the election was about deregulation. So I'm finding a lack of, I hear you on all the other issues, but the growth is out of them. The leverage that should have ever been there is not coming back, but that was the only reason why you should buy banks. And now deregulation with a divided government, you're not getting any more of that.
But you're not getting any less either, right? You're not. So it's a status quo.
It's already
and all these things you could have said the whole way up, and I would agree with you. And that to me is why banks should probably trade at 1 times book. They should look like a utility, at least in their current state. Yeah. Now that they're trading below book, to me, it makes sense to buy them. And then secondarily, you're not going to get much of a change in this environment. And with a flat yield curve, what do banks do? They lend more.
They are dirt cheap. I mean, Goldman Sachs, as an example, it's trading at a PEG ratio of 0.55 and
That's not the kind of bank you like, though.
No, I don't.
Anyway, proceed.
So, the banks that we like are going to be those banks that have exposure to the capital markets, right? We want to make sure that given heightened volatility, that they have an opportunity to actually benefit from trading revenues. So Goldman Sachs right now to us looks like a no-brainer. I mean, 0.78 times book value. We're talking 0.55
You think that
peg
House
ratio.
of Rep with the Dems running it, you think they're going to be pushing trading revenue for the big banks?
I don't think they're going to push it.
This capital markets are very bad. The comps are going to be hard, and this all the MiFID stuff. I mean, that's certainly equities. That's not a growth area. That's a shrinking area.
Why do you hate Mark's trade?
I don't know if I hate. I mean, I like it on a valuation basis, right? It's one of the ones that are cheaper on price to book. Problem that I have with Goldman Sachs is they're not necessarily that markets player anymore. There's a transition going on. It's kind of I hate to say turnaround story, but it's unclear to me what they're going to look like. So why not just go with a pure play on the banks, like Bank of America, one of the cheapest on a price to book ratio? Just go with one of those. Somebody that does the lending, that is out there expanding their book. To me, that's a good play.
I mean, I guess it gets down to this. I have a lot of clients say the balance sheets are the best they've been in years. The leverage is low, and so there's not as much risk in them. But if and as equities in general have topped and we're looking at more downside, the odds that banks or financials will outperform, the odds are low.